Larry, give us your sense as President Biden looks forward to the possibility of perhaps appointing the chair and two vice chairs of the Federal Reserve, who, without regard to who it might be, whether the present people or others, what do we need? What are the issues the Fed's likely to have to address over the next 3, 4, 5 years?
Look, the most fundamental choice the Fed's going to face involve monetary policy. They involve making judgments about the inflation risks that I've expressed concern about going forward, whether those, whatever the right view is, and they involve the monetary policy challenge of a long-run environment where we're going to have exceptionally low real interest rates, at least if one looks at markets and a variety of other indicators. So I think it's the macroeconomic policy that's at the center of the Fed's responsibilities, and that's really the core task. Clearly, you need someone with a deep commitment to a stable financial system who understands that Dodd-Frank was a beginning and not an end. So for me, monetary policy followed closely by financial stability. I believe that it's government's job to deal with the environment. It's government's job to deal with social justice. And I don't think that trying to push those responsibilities to the Fed should be a priority. So my hope is that it will be someone who can provide guidance with the right wisdom and the right character on monetary policy and also on the maintenance of financial stability.
Can you divide up those two responsibilities to any degree? Because one might think in the structure as it's been put together, it's really perhaps the monetary policy for the chair and you have a vice chair for supervision. Does that work, or do you need a chair who's particularly strong in regulation as well as monetary policy?
I think that that a chair can choose to delegate substantial amounts of discretion with respect to regulatory policy to a vice chair. A chair who is committed to the wrong kind of deregulationist attitude could do enormous damage. But a chair who was relatively separated from those issues on a day-to-day basis and gave support to a strong vice chair focused on financial stability issues, I think that could work very well.
So you mentioned first and foremost monetary policy. Give us a sense of where we are right now in monetary policy. And let's be honest, most people talk right now about so-called tapering, when they start backing off of the bond purchases, and then eventually some interest rate raise. We just got this week new jobs numbers that were better than expected. The unemployment rate fell to the lowest rate it's been since before the pandemic. Does that tell us anything about that question about monetary policy and tapering?
Look, I think the Fed has misjudged the overheating risk. I think given that they have an instrument that operates with lags, given the level of inflationary pressure in our economy, given prospective growth and closure of the GDP gap, given the extent of inflation in the housing markets, given record levels of job openings, I don't think they should be buying anything like $40 billion a month of mortgage-backed securities or $120 billion a month of treasuries. What they are doing is shifting America's funding structure towards being shorter term rather than longer term. If there was ever a moment to be locking in long-term funding, I think it's this moment. So I think the Fed should be moving with all deliberate speed to tapering. It should be signaling its concern about overheating. It should be recognizing that there may well need to be a tightening in terms of raising rates well before what's now embodied in the dot plot or what's embodied in market expectations.
So when I mentioned exceeding expectations of the jobs numbers, it wasn't just the number of jobs, it was also wages. They came in at 0.4% up rather than 0.3% up. Next week, we're going to get CPI numbers for inflation. All these are individual data points, but at this point, you've been very concerned about inflation. Where are you on where we're headed? What do you expect?
I don't know what the CPI number's going to be. It's driven by a lot of special factors. What I think you need to do is look over some months, and you need to look at the degree of tightness, which is what points towards future measures. We had core CPI rise at above a 10% rate in the second quarter. That is obviously going to come way down. But that does not mean that we are comfortably in range of achieving the Fed's 2% on an average basis target. And that's why I'm concerned. There are forecasters, I don't know whether they're right or not, who are looking for growth at a 9% annual rate in the third quarter. When you start with high inflation, you have the unemployment rate fall by 0.5% in a month, and you're looking at growth at annual rates of 9% going forward, you should be worried about overheating. And instead, we hear much too much of the rhetoric of transience in the inflation rate. Of course, some of it is transient. The question is whether we're going to wake up with an underlying inflation rate above 3%. And I think we are courting that risk, which would come with very serious political and economic consequences, much more than we should.
Larry, as a macroeconomist, factor in, if you can, the Delta variant, because something that's just developed in the last week or two has been a lot more concerned about the Delta variant. It seems to be much more virulent than we understood. Could that be a headwind on some of that growth?
It certainly could be a headwind on growth, but the question is whether it's going to be a headwind from the supply side or from the demand side. And if, as I suspect, it's going to be as much a headwind from the supply side, then when you get a reduction in supply, it slows growth, but it raises prices. And so I don't see the Delta as making me feel better about inflation. If anything, it may be making me feel a little worse about inflation. And I will tell you this, David, I think when historians look back, they may regard the biggest error the United States made in 2021 as being the failure to lead a global Marshall Plan for vaccinating the world.
So let's wrap up as we do every week with a rapid round of Summer Says. Got three of them for you this week, Larry. First of all, cryptocurrency, very much in the news in all sorts of different ways. But my question to you is, from where you sit, is the greater risk over-regulating cryptocurrency or under-regulating it?
Greater risk is under-regulating it. If we regulate it right, we'll protect a lot of people. We'll be able to enforce against financial crime of various sorts. And ultimately, by regularizing and making more trustworthy cryptocurrencies, will enable the benefits of cryptocurrency and the success of the cryptocurrency industry to grow.
Okay, a second one, also much in the news this week, is Robinhood and what it means about retail investors. As you look at the overall financial system, is that more of a risk or more of an opportunity? It's, on the one hand, democratizing it. On the other hand, there's a lot of volatility associated with it.
We're seeing some version of the errors of the 1920s there. This is as clear a case for enhanced regulation as I've ever seen, and we need much more serious approaches to meme stocks, to the marketing of stocks, to problematic retail investors. This whole meme stock phenomenon is not going to end well.
And finally, let's get back to employment. When do you think we will reach full employment at the rate we're going?
I think we're pretty close, David. If you look at job vacancies, we're at record levels, higher than we've ever been. If you look at the rate at which people are quitting, which is an indicator of how secure they feel in the labor market, that is at historically record rates. If you take account of the fact that because of COVID and everybody's moving to different places and thinking differently about the kinds of jobs they're going to do and we're going to do them, we've got much more structural change. I think we're not far from full employment, and certainly the tendency of wage growth to be accelerating, especially when you adjust for the quality of workers. All of that tells me that we're within 9 months or a year, certainly maybe less than that, of getting to full employment from the perspective of what's feasible and what's consistent with stable inflation.